The finance function can be carried out through a number of different business organizational forms. The three that we're going to be most concerned with are the sole proprietorship, the partnership, and the corporation. A sole proprietorship really is just an extension of an individual's personal activities. It represents a single person ownership, and the advantages are that the owner really has very simple decision-making process. The owner just decides what he wants. It's got very low organizational forms, low operating costs, low legal costs to get the sole proprietorship started, and profits and losses are taxed to the individual owner just as part of his normal income. Now, there's a significant drawback to sole proprietorships, and that is that the sole proprietorship, because it's not a separate entity, the owner is personally liable for all of the business's liabilities. So if the business goes bankrupt, the individual is also going bankrupt. The creditors can go to the owner and take his own personal assets to satisfy any claims that they have against the sole proprietorship. Now, a second form of business organization is the partnership. It's similar to a sole proprietorship, except that there's more than one owner. It requires a little more formality. There are articles of partnership that specify what the ownership interest is of each of the partners. It describes how the profits are going to be distributed, and it describes how a partner who wants out of the partnership can get out, or how other partners can get rid of a partner. So it's a little more complex. Having said that, it also carries unlimited liability for the owners. There are entities referred to as limited partnerships. In the limited partnership, one of the partners is the general partner, and the general partner is charged with managing the partnership and has unlimited liability for the debts of the partnership. The other partners are what are referred to as limited partners. What's limited about them? Well, their liability is limited. The limited partners don't engage in day-to-day management of the partnership, but they're not on the line for losses that partnership incurs. One of the problems with limited partnership is that in many cases, for example, banks may be unwilling to lend to a limited partnership unless the limited partners promise to be held liable for a bank loan. So the lenders may very well, or people that deal with a limited partnership may very well say, we're not too concerned about whether you call yourself a limited partnership or not. Unless the limited partners agree to be liable for our debt, we're not going to loan you money. Nevertheless, there are instances where, for example, perhaps a legal claim might arise due to an accident by an employee. Well, the limited partners wouldn't be on the hook for that. So that adds some protection and limits the liability. The more pervasive, certainly most of the significant businesses in the United States are in the form of a corporation. Corporation is a unique legal entity unto itself. It's separate from its owners. There are articles of incorporation that specify the rights and limitations of the entity. The owners of the corporation enjoy limited liability. If you own stock in the Coca-Cola company and the Coca-Cola company does something that causes the firm to be liable to some creditor, the shareholders don't have any liability. The stock could lose all value, but the shareholders, no one can come to the shareholders and say, we want some extra money from you. The corporation has an unlimited life. Unlike a sole proprietorship that dies when the sole proprietor passes away, the corporation lives basically forever. If shareholders die, the stock is passed to their heirs, the corporation keeps on going. A key feature of the corporation is that it divides ownership interest by shares. So one individual may own more shares than another. If they wish to sell their shares, they can do so. That doesn't cause the corporation to terminate. It just changes who the owners of the corporation are. In the U.S., a significant disadvantage of corporate form is the potential for double taxation of earnings. The corporation pays taxes on its earnings, then it turns around and pays a dividend to its shareholders. The shareholders have to pay tax on the dividends. So the earnings are taxed twice, when earned by the corporation and when distributed to the shareholders. That's not an issue for partnerships and for sole proprietorships. So the tax burden is lower on sole proprietorships and partnerships than it is on corporations. With that in mind, there are a couple of entities, one called an S corporation, that is a corporation that essentially has agreed to have its shareholders pay the tax that occurs on earnings, and there is no double taxation for the most part for S corporations, sometimes referred to as a subchapter S corporation. There's also an entity more recently developed called a limited liability company, which allows it's really sort of a hybrid organizational form between the corporation, partnership, and sole proprietorship, but it has limited liability for the owners, but only one level of taxation.